Well, hello, everyone, and welcome. This is Cynthia Tomane with Interactive Brokers, and you've joined today's webinar that's being brought to us by Qplum on building cost-effective custom investment solutions using AI. I'm very pleased to have with us this afternoon Marissa Palestino with Qplum, who's going to give us a little bit of background, and also introduce us to today's presenter. So, Marissa, oh, there you are,
Thank you,
unmuted.
Cynthia.
Thanks for joining us.
Thank you, Cynthia. Hi, everyone. My name is Marissa Palestino. I'm part of the client relations team here at Qplum. Our speaker today, Calvin Yu, is the managing director and head of multi-asset solutions at Qplum. Calvin has over 12 years experience in multi-asset investing. Prior to joining Qplum, he worked at Goldman Sachs as lead portfolio manager and outsourced chief investment officer, managing multi-asset portfolios for institutional investors. As a brief background on Qplum, we're an AI-driven asset manager using deep learning in research, development, and implementation of systematic investment strategies to manage portfolios for institutional investors and high net worth clients. We invest and manage assets for individuals and institutions using systematic AI-driven investment strategies across all major asset classes. Please feel free to submit your questions to us via chat, and we will address them at the end of Calvin's presentation. I will now hand over the presentation to Calvin to begin our discussion on building custom investment solutions using AI.
Great. Thanks, Marissa. So thank you, everyone, for joining. It's a pleasure speaking to you all today. And a little bit of housekeeping before we begin. As Cynthia mentioned, this webinar is being recorded and will be made available. Also, we'll have some poll questions along the way, and we'll save some Q&A towards the end of the presentation. So the topic of today's presentation is on AI investment solutions. Now, AI has certainly been a hot topic in recent times. Technology is advancing at an exponential rate, and it's really amazing how technology helps in our daily lives today compared to 10 years ago. And if you think about it, we're already using AI in many parts of our daily lives today, be it from, say, Netflix, which has learned about your own preferences and designs a custom playlist recommending you what shows to watch and so forth. Similarly, Amazon suggests what things to buy, and Google helps you navigate through your daily lives, and so on. Now, just take a moment and imagine what we can achieve if we were to apply AI in investment management. So by way of introduction, I'm Calvin Yu, and as Marissa mentioned, I head up multi-asset solutions at Qplum, where I work with investors to design investment strategies using our AI framework. I've been in the multi-asset portfolio management space for about a dozen years, and I started off at JP Morgan, where I helped launch an outsourced chief investment officer, or a OCIO business within the investment bank. And so this business started off in 2007 as an idea. We had no clients, no assets, but this business grew quite substantially and was later on acquired by Pacific Life, and then subsequently acquired by Goldman Sachs in 2015. And so for 3 years, I was a lead portfolio manager at Goldman, where I managed institutional multi-asset portfolios and worked with many CIOs of large multi-billion-dollar pension plans, as well as other institutional investors. A little bit of background on Qplum. So Qplum was founded by Mansi Singhal and Gaurav Chakravorty, and a little bit of background on those two individuals first. They were both pursuing their masters in computer science with a focus on artificial intelligence applications in finance back in the early 2000s. They were studying at the University of Pennsylvania, and when they graduated, Gaurav joined a high-frequency trading prop trading firm called Tower Research Capital. And there he started off straight out of school, and he was tasked to develop a lot of trading, systematic trading strategies, and really trying to hone in on using machine learning and artificial intelligence to design profitable trading strategies and so forth. And so that's exactly what Gaurav did. And initially it was just Gaurav, but these strategies proved to be so successful that it actually grew, and he ended up leading and managing a team of 50 plus engineers. And these strategies were so profitable, it was actually one of the most profitable trading groups at Tower Research Capital, and he was made partner in 3 years' time. So he was actually the youngest partner there. And then so in terms of Mancy's background, Mancy, after she graduated, she did trading at different investment banks and eventually ended up at Brevin Howard, a large global macro hedge fund, where she was a portfolio manager there. And between the two of them, they thought that AI is really disrupting everything. You can look at many different industries, and you can see that artificial intelligence has major impact in disrupting how those industries are performing. And as they looked at the AI they developed at their own respective firms, they thought, the AI they've developed is so powerful that maybe they should join forces and create a company to make asset management more efficient. So they launched Qplum in late 2014, early 2015. We're a team that's very much focused on technology, and you can see in the pie chart that most of our team comes from engineers and data scientists. So today, Qplum, like we said earlier, we invest and manage assets for individuals and institutions using a systematic AI-driven approach to manage investment strategies across all major asset classes. So in terms of today's talk, we'd like to cover three main points. The first is that many investment organizations follow an investment process, but there are certain aspects of traditional investment processes that may be improved. The second is that every investor has their own unique goals and objectives, and so a one-size-fits-all approach may not be suitable, and a custom solution may better meet their objectives. And then the third thing is that AI can be a great tool to help deliver those custom solutions, and that technology is available today. So again, to summarize those 3 points, 1, traditional investment strategies may be improved. 2, custom solutions better meet objectives. And 3, AI can deliver custom solutions today. So coming to that first point on how traditional processes may be improved, let's just spend a moment on what's defined as a traditional investment process first. So each institutional investor may have a different investment process, but at a high level, many institutions have an investment committee that follows an investment process that's similar to what's outlined here. The first step is to identify investment goals and objectives. And so, for example, they'll determine the return objectives, the benchmarks, risk tolerances, constraints on permissible investments, and so forth. After the investment objectives are determined, a target portfolio is selected, typically using various strategic portfolio optimization techniques to construct that portfolio. And then after selecting that target portfolio, the portfolio is implemented. And depending on the asset class, a lot of the implementation vehicles may be with standard off-the-shelf funds. And then on an ongoing basis, the portfolio is monitored to make sure it's in line with a target portfolio. And then they may want to decide to act on tactical opportunities as appropriate. Now, while this traditional investment process outlined is a sound approach, there are some potential considerations and certain elements of the process can be improved. So I've highlighted 3 issues I often hear from some of the investors I've worked with. So the first is outdated capital market assumptions. A lot of institutional investors develop strategic asset allocations every couple of years based on long-term capital market assumptions, which are developed using backward-looking historical data. But in today's fast-changing markets, the strategic asset allocations developed a couple of years ago using outdated capital market assumptions may not be applicable in today's market regimes, which leads to the second issue, which is delays in acting on tactical opportunities. So as I just mentioned, markets are dynamically changing in real time. I've outlined in this chart in the middle the performance of the best to the worst asset classes for each calendar year. And as you can see, there is no real pattern. The best performing asset class in one year can be the worst performing asset class in the next year. The markets are just constantly evolving in real time. And so what many institutional investors find challenging is it's challenging to convene their investment committees and quickly decide how to act on those tactical opportunities in a timely fashion. The third issue is that most fund managers act in isolation and do not take the total portfolio investments into account in terms of a total portfolio context. So for example, there may be 4 fund managers within a portfolio, and each manager is focused on beating their respective benchmarks within their own portfolio. So the active views of one manager may be offset by opposing active views of another manager. And so it can be really challenging to take those views of each manager into account in real time when managing the overall portfolio. So these are just some of the issues that are faced by investors as they look at the traditional investment processes. And with that, I'll turn over to Marissa to talk about some of the poll questions.
Our first poll question is, which of the following are limitations around traditional investment processes? Everyone get in your answers. I'm closing the poll soon. All right, I'm closing the poll.
Great. Yeah, so delays in acting and may result in missed opportunities was the overwhelming response, and that's exactly right. But I think a lot of times as investors are looking at opportunities in the marketplace, it's hard to convene their investment committees to act on those opportunities in a timely fashion. So that's certainly one major consideration and limitation around traditional investment processes. So with that, I'll continue back onto the slide. So in terms of the custom solutions, we feel that some of these issues can be addressed using a custom solutions approach to better match and meet the investor needs, which brings us to the second point, which is, again, custom solutions may better meet objectives. And actually, what we think is interesting is just like the traditional investment process, a custom solutions process starts with a series of interactive discussions with the investor to understand their situation, their goals, objectives, risk tolerances, preferences, and so forth. And from those discussions, you can then map out a custom utility function based on those investor preferences and their desired return profile. Then based on the investor's unique utility function, you can then design investment strategies that take their specific preferences into account. And so diving deeper into that customization process, we've outlined an illustrative approach to design and implement a custom investment solution. So we already talked about the first step on defining the investment objective in terms of returns, risk, constraints, and utility functions, and so forth. The second step is to design the investment solution to best meet those objectives based on the investment parameters, the risk budget, the applicable investment universe, the appropriate investment strategies, risk management considerations, and so forth. The third step is to test the strategy through a set of studies or experiments. And now these tests may include a blind walk forward backtest, a scenario analysis, simulations to evaluate the portfolio characteristics in different environments. And all of these steps can be revisited with the investor through interactive sessions and discussions. So for example, the investors may tweak certain conflicting goals and objectives after they see how those strategies perform in different market environments. And then once a strategy is agreed upon, you can then implement the custom investment solution by constructing the portfolios, trading it, taking into account things like tax optimization and currency hedging considerations, and then monitoring it on an ongoing basis and then revisiting each step as needed. And so with that, I'll pass it over back to Marissa to talk about the next poll question.
Our next question is, how do custom investment solutions address limitations around the traditional investment processes? I'll keep it open for 10 more seconds. Okay, I'm closing the poll.
Great. And so, yes, the first response is the one that I was expecting, that custom investment solutions can account for unique investor mandates and their objectives, constraints, and desired profiles that they're trying to reach. So, yeah, that makes sense to me. And so we think custom investment solutions may better meet investor objectives. And this brings me to my third point, which is with the advent of big data and cloud computing, we think AI can deliver custom solutions today. And so AI is a broad universe of strategies. And in this webinar, we're actually going to focus more on deep learning and neural networks, which are types of strategies within machine learning strategies. And we'll use these as illustrative set of strategies that we'll talk about in more detail. But before diving into how deep learning can help with developing custom investment solutions, I'll provide a little bit of background for those who are not quite familiar with how they work. So neural networks are loosely inspired by the human brain. So if I were to talk about what our brains are doing right now, as you are looking at this webinar and viewing this webinar from your computer screen, what's happening is light is bouncing off of your lights, reflecting off of your computer screen and entering into your eyes, and then your brain is registering that information. So that's all the input. Now, all this input you can imagine is all the light particles coming from all these different light sources. And your brain takes all this input, summarizes this information, and then determines the output, which is the critical piece of information that you need to register and focus on. So using that computer screen as an example, when light enters into your eyes and into your brain, the first thing it registers are these simple patterns. And so all these, the light, maybe the first kind of layer of information it sees are lines and edges. So from the patterns of the light particles, you can see like, okay, there are certain horizontal lines and vertical lines and so forth. The first layer of the brain's kind of intuition is on those lines and edges. The next layer, it tries to take those lines and edges and form different patterns. And so maybe it sees a horizontal line, a vertical line, another horizontal line, another vertical line, and the brain registers, oh, that's a rectangle. Okay, great. Now we register that it's a rectangle. The brain kind of uses further layers of complexity to map out different things. So from that rectangle, I see maybe from the color or the reflection or textures or whatnot, I understand that it's a computer screen I'm looking at. Okay, great. The next layer could be I see these slides and all these like graphs and stuff. Oh, I understand that this is a slide deck that Qplum is reviewing on whatever it might be. And so that's what's happening with your brain. And neural networks, as it relates to a deep learning setup, they're set up to emulate that process that goes on in your human brain. There are inputs, there are layers to summarize information to determine the output. And so there is a simple calculation that takes place within each neuron, and that gets passed through an activation function. You can think of that as a nonlinear transformation. So this process is automated and continues until we reach the end of the network, which then determines the output. It is a combination of a bunch of simple calculations that allow it to understand complex relationships in the data. And what ends up happening is that neural networks build up layers of complexity as they go deeper into the network. And so they are learning hidden representations of our data, and this ultimately allows us to model quite complicated relationships in our data. So translating all of that back into financial markets. So the inputs, instead of it being light particles or whatnot, you can view the inputs as all sorts of financial information, be it market information, so price, volume, or macroeconomic data, or market in terms of different asset classes and so forth. All of that information can feed through a neural network, and this neural network can then map out relationships that we see in the financial markets, which are very complicated and can be very interspersed with multidimensional aspects to things. So the markets, because they're so very complicated, oftentimes there are hidden representations in our data that we are unaware of, and we need a powerful algorithm to truly model it. And I think overfitting is obviously a big risk when using powerful models such as these neural networks, but there are some precautions that you can take to mitigate this risk, and we'll talk a little bit about that later on in the presentation. And so as we move along, we've actually published a white paper outlining one of our strategies for using deep learning in tactical asset allocation. This is a simplified version of one of the many AI-driven strategies we use at Qplum, but it acts as a good example to illustrate the main concepts. We've also covered this white paper in past webinars, so I won't repeat too much here, but the goal in this white paper was to try and predict how different asset classes will do in different market environments using deep learning. So you see here, we set up a deep learning model to predict expected returns for different asset classes. And moreover, we thought it was important to gauge the level of uncertainty in the predictions. So we use a Monte Carlo dropout to ensure that the model doesn't necessarily overfit and that the relationships are more generalized. And for those of you who are not familiar with dropout, well, if you recall that neural network analogy, and we had all these neurons. So with a neural network, it had all these neurons and that they're all connected to each other. So basically what a dropout does is it randomly shuts off numbers of these neurons each time you run the network, and you can specify the percentage of the total neurons to shut off. And originally this was done as a form of regularization because by doing this during training, it allows your neural network to not depend on any one particular neuron in particular to make a prediction, which hopefully should help generalize things better and make sure your overall model doesn't necessarily overfit. However, what we found is that you can actually use this during inference and run the neural network multiple times to get a distribution of possible predictions. If we take the standard deviation of this prediction, what we can actually get is a measure of prediction uncertainty. And so, as you can see in this diagram on the slide, this is an end-to-end automated approach to generate portfolio allocations using deep learning. That blue layer represents the return prediction model. The green node represents the uncertainty that we calculate using this Monte Carlo dropout. And then we also track how well the model predicts each asset class. If the model predicts one asset class much more consistently than the other, then it should probably trust those predictions more. And so we then combine the expected returns, the prediction uncertainty, and the prediction error into one last layer that takes all of this into account in forming portfolio allocations. And so you can see how the model allocates to different asset classes over time based on the then current market regimes and the relationships in the deep learning model. And you can see that it's de-risking during volatile periods and then quickly reallocating back to risky assets when markets are starting to normalize. And here you can see how the model performs over time as well. And just a quick note, you might notice that performance here varies between the different runs. Without getting too technical, it's because each time we ran it, we randomly initialized the weights within the neural network. So because each neural network had a different starting point, and because we don't necessarily run it until convergence to prevent overfitting, the network makes slightly different decisions between each run. But for the most part, you can see that the decisions are very consistent, and you can later on even try to take average of all these different runs to determine a composite strategy performance. But some of the interesting findings of this paper were the fact that, for instance, a deep neural network that was trained with no look-ahead bias performed actually very similarly to a risk parity set of strategies. And risk parity, as a lot of us know, it's a thoroughly researched and handcrafted strategy. So by the fact that we were able to use a deep learning framework to perform similar, if not better, to a risk parity strategy was a very interesting finding. And then also the architecture was shown using a Sharpe ratio as the main utility function. But the great thing about this is you can specify any objective function that you want. And so this helps with then designing different custom investment solutions. And additionally, because this is end-to-end automated architecture, which is systematic, it allows you to create very unique custom solutions, but in a very cost-effective manner. And we can spend a little bit of time talking about that later on. But like I said, I think this is one of many AI-driven strategies that we use at Qplum. We then overlay on top other strategies as well, which we then help make more improved investment solutions that are customized to different investors. So in terms of what we have been talking about so far, it's been a little bit conceptual or theoretical, but we can now shift gears to talk about some real applications of AI in portfolio management. So here is a illustrative example where Qplum was asked by an institutional investor to design a set of custom risk-targeted global tactical strategies based on the following specifications. So the strategies was a global tactical asset allocation set of strategies. The benchmark was a set of risk benchmarks based on the global market cap portfolio. And the volatilities were targeted at the 12% volatility level, 8% volatility level, and the 4% volatility level. So you can think of it as different risk tolerances that an investor might be looking for. In terms of the universe, it was all in global equities, fixed income, and commodities. There was a drawdown and risk management set of framework that was based on client specific risk tolerances. And then from an implementation perspective, we were asked to use listed ETFs all implemented in a separately managed account. We were also asked to use currency hedging and really take a dynamic currency hedging approach using AI to reduce hedging costs. And then lastly, the liquidity of the strategy was to be on a daily basis. So given all of these parameters, we had very iterative discussions with the investor, and then you can see how the strategies performed in the initial set of scenario analyses. We had, like I said, a series of discussions from there and iterations where the investors further came back to us to refine those strategies. And then from there, we were able to finalize a set of risk-targeted global tactical strategies and launch it on their behalf. A second example is the following. So far, everything we've talked about was in the multi-asset space. But actually, these deep learning strategies can work within an asset class as well. And so Qplum was asked to design a custom multi-factor long-short equity strategy based on the following specifications. So the strategy was a long-short 130-30 small mid-cap equity strategy. The benchmark was the Russell 2500 growth. The universe was simply the US small and mid-cap stocks. We were given an active risk budget of 2%. They wanted us to target a beta of 1 to the benchmark, limit the portfolio turnover to below 150% on an annualized basis, and the implementation was all done via single name stocks in a separately managed account, and we were asked to do this with daily liquidity. So from there, you can see that the strategies performed from these initial sets of, again, backtest and scenario analysis. And even though this strategy was focused on one asset class, the small mid-cap market, we're able to dynamically time the stylized factors within each of the stocks using the AI approach to develop this custom investment solution. So as you can see, I think AI can be a very flexible, and if designed well, it can be customized to different applications. And I've outlined 3 other examples here as well for illustration. The first is in liability-driven investing. So many financial institutions have to manage both assets and liabilities. The assets may be invested in a liability hedging portfolio to mitigate liability risks, while the rest of the assets may be deployed in a more diversified return-seeking growth portfolio to generate strong returns. And so just like those strategic asset allocations I talked about earlier in the presentation, these asset liability studies are typically conducted every few years. And again, that uses those dated assumptions, those dated capital market assumptions, and don't necessarily take live market information into account. And so you can use deep learning to dynamically allocate between the growth and liability hedging portfolios in order to take advantage of live market dynamics. The second example is in portfolio allocations across different investment managers or investment strategies. So for example, within, say, international equities, a CIO may invest in 4 different managers. The CIO may decide the allocation between the managers based on their style, their active risk, their correlations, and so forth. And so deep learning can dynamically allocate between the managers, taking those same considerations into account. And the last example is in portfolio construction within a sub-strategy. So for example, if you were to build a portfolio of direct investment in large cap stocks, you can use deep learning to construct the portfolio with key focus on parameters like volatility, to make sure you limit realized volatility to a certain level, downside risk, where you again limit downside risk to a certain targeted threshold, your beta or your correlation to be targeted to certain characteristics to make sure that there are sensitivities to other parts of the portfolio that you're taking into account, your active risk or your tracking error, you might want to have those within a certain range, And then from a implementation perspective, as you're constructing the portfolio, you want to take currency hedging into account. So you can, again, use AI to dynamically hedge currency risk to reduce those hedging costs. And you can also use it from a tax optimization perspective as well. So really, you can really use AI to dynamically construct a portfolio to best meet your needs. And so to recap on my third point of the talk today, it is that AI can deliver custom solutions, and we think that technology is available today. So with that, I'll pass it back over to Marissa to talk about the third poll question.
Our third and final poll question is, which of the following can be custom investment solutions? Everyone get your votes in. Okay, I'm closing the poll.
Great, thanks, Marissa, and yeah, thanks everyone for responding to this. The answer, yes, all of the above. You're right. All of those sets of strategies we've outlined can be done in a custom investment solutions framework, and we really think with AI today we can do this in a very efficient manner. So what did we learn today? Again, one, we think traditional investment strategies or traditional investment processes may be improved. Two, custom solutions better meet objectives. And three, AI can deliver those custom solutions today. So we use AI in many other parts of our daily lives, and systematic investment strategies have also been around for decades. With proper AI design, we think portfolio management can be much more efficient and can help design custom investment solutions that better meet investor objectives. So it was a pleasure speaking to you all today. Feel free to reach out over email, check out our website, check out the white paper that I referenced, and also check out the past webinars that we've talked about on some of these topics. But I look forward to carrying on the conversation and seeing how we can use AI to help add value to your organizations. But with that, I'd like to open up to any questions. Thank you very much.
Well, thank you, Calvin. And I'd like to remind everyone that you can ask or pose any questions using the questions panel that's located in the control panel on the right-hand side of your screen. If you've joined from a tablet, you'll find a question icon up at the top of the window. So if you do have any questions for Calvin, now's the time to go ahead and add those. And while I have just a moment, I also would like to remind you we're recording today's event, and you'll all get access to today's playback as well as to Calvin's slides. So with that, I'm going to turn this back over to Calvin. Do you have any questions? Are you seeing any questions there?
Yeah, we'll now take this time to address some of the questions that we received during Calvin's presentation. The first question is, Ben asked, what's the minimum investment required to design a custom investment solution, and how long would it take to implement and launch the strategy?
Thanks, Ben. I think it really depends on the complexity of the mandate. For mandates that that are very similar to some of the strategies that we have built already, the process can be very straightforward, and the minimum investment there can be fairly low. But for more complicated mandates that are a little bit more nuanced, well, we can obviously have discussions with you. But there we would have to talk about the relationship and so forth. But feel free to send me an email, and happy to talk about that. In terms of your question about how long it would take to implement and launch the strategy, I can tell you that we've done this for other investors and asset managers and institutional investors and so forth, and we were able to start from, I'd say, from ideation all the way to connecting with different custodians and brokers and getting the operational onboarding set up and all that sort of stuff to launch and trading of the strategy took us around 60 days. So that was one example. And then to the extent that people, I'm also starting to see questions about fees, and it's somewhat related to this. I think minimum investment and fees wise, I'd say that our approach, as you can see, it's an active approach, and you can see that it's using AI to systematize things, to automate things, but do things in an active way. But the beauty about it is, even though this is an active approach, we're able to develop strategies and charge things almost at a passive like vehicle. So that gives you a sense of how cost effective these strategies can be, if that makes sense.
Thanks, Calvin. Another question is, Chris asked, interesting back-tested performance, but how was your realized performance in 2018?
Okay, thanks. So I think it depends on the strategy type, obviously. So in our portfolios, we manage a few different strategies, be it from long-only global tactical asset allocation system strategies to long-short, more alpha-focused portfolios. So in those long-only, and particularly when it's long-only and when the asset classes for all were down in 2018, and you can't necessarily go short, the portfolios can really be penalized. And so it really depended on the risk target that we're trying to target in those portfolios. But the portfolios in those long-only global tactical asset allocation strategies, those performance varied in 2018 from down 4% to down 7% on an annualized basis in 2018. But those alpha-focused strategies where you can go long, short, and so forth, actually for 2018 was up 20%, up actually more than 20%. I think it was like up 22% or so. So that gives you a sense of our performance in 2018. I'm just looking through some of the other questions here.
Doug asked, since your firm comes from high-frequency trading background, do your portfolios trade very frequently?
Thanks, Doug. And so I guess in terms of portfolio trading and how frequently we trade, it again depends on the mandate, and that's a specification we can talk about when we design the strategy for you. And so it again depends on the mandate, but even in our portfolios today, I would say it depends on if that portfolio is taxable or not. If it's taxable, we actually have the portfolio turnover around half a turn a year, and if it's non-taxable, we've gotten that to be around 2.5 times a year. So that gives you a sense of our portfolio turnover. But again, we can target different portfolio turnovers. So if that's an issue, we can talk about that.
Mike asked, will Qplum be available to Canadians anytime soon?
Thanks, Mike. So we've been having conversations with some Canadian investors, and so to the extent that this is a set of strategies that, and you're based in Canada and you want to talk to us. I mean, actually, myself, I'm born and raised Canadian, so I always love to talk about Canadian topics and so forth. So please feel free to reach out to me, and we can talk about different ways that we can collaborate on a set of strategies that might be suitable for you.
Philip asked, do you have solutions leveraging alternative data sources?
In terms of alternative data, we typically shy away from the news feeds or the Twitter feeds and so forth, and we really stick true to more market information. And we've evaluated alternative data sources as well, we actually find a few things that's limiting. One being the fact that a lot of times it's inconsistent, and so you can't have a good sense of consistency of the data sources. Another thing is just that alternative data feeds or alternative data sources, I guess, haven't been around for as long a period of time, so you don't have as much history to learn from. And then the last thing, if I were to using the Twitter feeds and so forth as an example, another thing that just some people find hard to grasp is just the sarcastic factor. So sometimes taking these alternative data sources into account, you're risking overfitting to data that may or may not be necessarily consistent or long enough that gives you the inherent nature that is needed to kind of learn from. And actually, just from using market information, and we can talk about the different types of market information that we use, but just using that in itself is already really good. And so we've been using it as more traditional market, be it from price, volume, and macroeconomic sources.
Joe asked, how are the strategy models implemented? Can they be embedded in proprietary investment software?
Joe, I think so. Right now, these strategies are implemented. We can talk about it, but most of these strategies are done through separately managed accounts. To the extent that you want to talk about different things or different ways that we can implement it, that might be more suitable to you. Again, please feel free to reach out to me via email, and we can talk about that.
Anthony asked, could you talk a little bit more about implementing these strategies for individual investors, technology, frameworks, etc.?
So thanks, Anthony. I think in terms of implementing these strategies for individual investors, because like I say, our framework is so automated and so flexible that even individuals can come to us and talk about custom solutions and so forth. So I guess to the extent that there's a certain solution that you have interest in mind, we're happy to talk about different ways that we can work with yourself. So again, just feel free to reach out to me on that.
The last question is there a minimum to open an account? And this is from William.
Hey, William. Thanks for the question. I think I answered it earlier, but yeah, it really depends on the complexity of the mandate. So I won't go into that response again, but basically it varies depending on how complicated your mandate might be. So again, just feel free to reach out to me over email, and we can talk about what it is that you're looking for as you're building your portfolio. And yeah, we can talk about what the minimum is appropriate given the strategy you're looking to target.
Thank you, everyone. That concludes the question and answer portion of our webinar. For any attendees who are institutional investors, please know that Qplum offers AI-driven investment solutions that can be customized to best meet your needs. Please feel free to send any questions to contact@qplum.co. Thank you, everyone, for joining today's webinar, and we hope to have you join our future webinars. I will now hand the presentation back over to Cynthia.